what are some of your takeaways from the recent ones? How are they different from the past ones? And if you could just anything you could shed on like just the learning lessons from them.
To be honest, I'm not a good person to answer that question because I don't know the full I'm not in any of those, thankfully, so I don't know the full details about them and how they happened and what people missed. But I will tell you my own learnings over the past 20 years in terms of some ways you can mitigate it. Number one is if you're going to go into, generally speaking, a fund or any type of investment that has many assets that are hard to track that maybe even turn a lot, those have a higher probability of having a Ponzi scheme from what I've seen. For example, if you're in a pool of 100 notes and it's hard to go and actually vet that they all exist and they're real, or if you're in a pool of 100 notes and they're turning every 6 months, even harder to really track them, pretty much impossible. So those give the sponsors more leeway to actually have more fraud if they choose to do that, right? Versus investing in one, if you go invest in one apartment deal with Dennis and you go visit the apartment with him, and if you really wanted to see the purchase and sale agreement he has, etc., you can get yourself to the point where there's the probability of a true Ponzi scheme is almost zero. It's never zero. And by the way, anybody can have a deal that wasn't either fraudulent, mismanaged, or a Ponzi scheme when you go into it, and it can turn into that. But I would also argue it's easier for it to turn into that when you're dealing with a lot of assets or a blind pool fund or other scenarios versus an individual asset. So that's one thing you can do in terms of at least being aware that those types of opportunities have higher risk for that, even though the risks are generally low. Like Ponzi schemes don't happen often, but they're never zero. Number two is, look, the more due diligence you choose to do, the more you can reduce the risk that it could be a Ponzi scheme upfront. Again, you can't really necessarily change what will happen in the future, but you absolutely can reduce your risk upfront. I'm going to give you guys a real life example. Okay. I have been investing in ATM since 2008 with two different operators. One of them started in 08, one of them started in 17. The one that started in 08 just sold their portfolio off this year and wound down. I have literally correctly pre-identified 3 Ponzi schemes while doing due diligence of ATM operators in advance during that period between 08 and 2023. And it was just purely from due diligence. And I literally concluded, I said, this is probably a Ponzi, maybe it wasn't, but this is probably a Ponzi. And they all 3 got broken up by the federal government. And so what I did with the most recent one I invested in, which in 2017, which was Prestige, I know a lot of you guys know them, is besides the fact that they are ISO, which means they're actually audited, sponsored, and supervised ongoing by a bank, which most ATM operators are not. And all 3 of those that I told you about were not, because it's much easier to be Ponzi scheme if you're not going to be audited, supervised, and sponsored by a bank. I don't know why you would choose to be an ISO. I got a letter of good standing from the bank that was actually that they're involved with to prove that they were actually in good standing. I went to their headquarters, met with all their executives, looked at all their terminals on their computers to see that the ATMs were real. That could be fake too, right? But it's actually a software system that I'm familiar with from my previous operator that I was somewhat familiar with in terms of like the processor. So I recognized it. Then I actually literally had them drive me across 5 states, okay, without being able to predetermine any of the ATMs. I get to choose them. And so when we got into Manhattan in New York, they took out an iPhone, 1,500 pins dropped on a map. There were all their ATMs. I said, which ones do you want to see? So I know this is a bit of an extreme position to take. And by the way, that doesn't perfectly help either, because I may have just chosen the ones that were there. Maybe 1,000 of the 1,500 weren't real, right? And so I looked at contracts they had in terms of buying their portfolios, even though they're not allowed to take photocopies and they're confidential. So I did about as much as I could. But I'm going to tell you right now, like there's not a 0% chance that it is or was a Ponzi scheme, right? You can never be 100%. They're still acquiring more assets supposedly and all this stuff. And I say supposedly, I totally believe they are, but it's technically possible they aren't, right? So the most important thing I can give you as a takeaway is the way you can protect yourself is to have diversification, right? Because anybody who invested with Madoff, with that unfortunate situation, if they would have invested 10% of their net worth into with Madoff instead of 100%, they may not be bankrupt. And so I'm not trying to point a finger at anybody. I'm just giving you facts, like it's an objective statement, right? Diversification is absolutely key. That's why I'm such a big fan of it. And that's one way you can definitely mitigate that. You want to be diversified across asset classes, geographies, and operators. So those are 3 key things.